Joining us right now to talk markets and some of the data that we got this week, Barry Knapp, who is Ironsides Macroeconomics Director of Research. Barry, where do you want to start with this? We've got a lot of new retail sales have come in. You had initial and continuing jobless claims. You had housing starts. What are things starting to shape up like?
All year, there's been, for me, two different scenarios where we could have a fairly significant drawdown in equities, 10%, let's say. One would be that we get 10s to retest 5%, and we have a real rate shock, and we threatened that a month and a half or so ago, late April. The other one is we get a significant growth scare. Some will, when I talk to clients about the growth scare dynamics, a real deceleration of growth, often you'll get the pushback that I'll get will be, well, we'll just look right through that to Fed rate cuts and the market will ignore it. I'm less convinced that that would be the case. And I do think the evidence of a growth scare is starting to build. It doesn't make me wildly bearish. I don't think it's likely we'd go into a recession, which would cause a deeper pullback, 20+%. But if you just think about the data that you're talking about, first, with respect to the labor market, there's this huge debate underway. I've been calling it the tale of two surveys, the household survey and the quarterly census on employment and wages imply that we probably had about 1 million less jobs last year than we originally estimated from the establishment survey. That uptick in the unemployment rate, the drop in job openings, all the things Chair Powell cited at the last press conference imply that the labor market is much weaker because of small business employment. The idea that, which we don't measure very well, and the idea that tight bank credit and rising rates that don't affect large corporates that were able to term out their debt, but that's really hit small business. You add to that, as you mentioned, retail sales, which through the first 2 months of the quarter are basically zero. And the starting point was a little lower because March has been revised down twice now. The housing data is taking a turn back lower as well, as is the manufacturing data. All the PMIs overnight look decidedly weak. And then within the equity market, which for me, it takes about 3 months of performance, persistent performance, to be convinced that the equity market's sending a real, call it efficacious or a meaningful economic signal. But I've been calling this an unhealthy broadening out, what was weakness in consumer discretionary, small caps, small banks, has now broadened out to energy, materials, industrials, and this is the quarter where their earnings are supposed to accelerate. In the first quarter, earnings grew 8.3, but that was entirely attributable to tech and communication services, the whole Gen AI boom. Right. This quarter, those other sectors are supposed to increase by something like 7.7%. There's no reason to believe it won't happen, but other than all this macro data and the price performance. So this is really sort of put up and shut up time for that broadening out that everyone expected this year. And it's really quite questionable.
Hey, Barry, I hate to interrupt, but I want to bring your attention to the fair value board. We are now looking at futures in the red. NASDAQ is indicated down by 10 points. The S&P futures are indicated off by 2.5. Joe's not listening to me, even though this is for him. The Dow is now indicated down by almost 10 points, so we have to watch this. You were
hanging your hat on that it had turned positive.
I am making a big deal of the fact that it has gone back down.
It was up 10 or down 10. You should save your excitement for when it really is
It is
true.
It is.
Otherwise, then when you do something that's really true, then it cheapens it.
Fair enough. But, Barry, what I will say is it sounds like you're surprised that we haven't seen a big pullback. We've been marching higher and higher and higher, and it sounds like you think it doesn't make a whole lot of sense, and you sound a little nervous.
I think the tech part of the story makes sense. I mean, last time I was in New York, I sat down and had lunch with my former neighbor and buddy, Dan Ives, and I get the whole Gen AI investment boom story, but we were supposed to broaden out and have the rest of the market perform better this year. I've been positioned for that. I've got overweights in industrials and energy, and they just haven't been performing, and so that's making me a little bit nervous, I would say.
Barry, I wanted to talk to you about the CBO, but we're out of time right now. Please come back, because I do want to dig a little more into these numbers. Very quickly, you pointed out that the revenue line since World War II really has only been about 17-18% of receipts.
Yeah, you nailed that yesterday. Joe called that out straight away. The only 2 years we went above 19% followed stock market booms. It was 2001 and 2022 after absolute booms in the market. So the only way to really fix that revenue line to get that number higher would be a complete restructuring of our tax code, something like a national sales tax. Otherwise, the problem is spending. That was the problem in the 60s that drove the inflation, the great inflation. And we have the same problem again. So, it's fixed spending or bust, so to speak.
Yeah. No, it just seems as plain as the nose on your face. I looked all the way back, and Roger was right that during the Clinton years, it was, I think, 19%. But the long-term average is 17.5%. And we used to spend under 20, and we were at 24. So, and we're going to stay at 24. So if you're right at the long-term average for revenue at 17.5, and you're 4 percentage points above on spending, how can it not be clear what the problem is, Barry?
I don't know, Joe. I find that fascinating every time someone comes on your air and says otherwise, because clearly spending is endogenous to growth, right? We've had a 90% top marginal rate, and we've got 17.5%. We've had a marginal rate of 28% under Reagan, and we got 17.5%. That's what we can collect under an income tax structure. But the spending side is clearly exogenous. It's set by Congress, and at 24%, there's no way to close that gap.
You know what, Barry, you're giving grist to both sides there, because there are people that think if you cut taxes, you can go above 17.5. You're saying higher or lower, you still get 17.5. I thought the government, it's the age-old argument. The government thinks that when it spends, it's investing. I mean, the government's the worst investor in the world, but at least let's say that they do know how. Let's say that they are trying to invest for future growth. What about the private sector? Can they invest why doesn't less money being spent on taxes bring greater growth in the private sector, Barry? You just said it doesn't.
Well, let's just think about it simply in terms of the costs that get borne. So in 1965, 25% of the population over the age of 65 had health care insurance. We started Medicare. We had a market failing. We started Medicare. Well, health care inflation went from 2.5% in 64 to 7.5% by 66. So we all paid for that expansion of health care. That started the great inflation. It then spread to housing and every other sector. So whether the investment makes sense from a social perspective or whatever or not, there's going to be a cost associated with that. And ultimately, that cost will be borne by the public, and it's through inflation more often than not. So that's what we're looking at again. We want to make the energy transition. We want to have $1 billion in subsidies for green energy investment over the next decade. It's going to cost us. And that's the bottom line.